Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, the reflation trade just won't go away. So the last 2 weeks, I've done a lot on the show explaining what's been happening in investment markets in relation to the rising bond yields we're seeing on government debt around the globe, but particularly in the US. Now, if we look at how markets have moved in the last week, you can see the reflation trade is still what is driving a lot of market moves. If we look at the last week, so since I made the last show, the Dow Jones Industrial Average is up 2%. Now, the FTSE 100 is up about 0.8%. European stocks are a bit better, around 1.72%. S&P 500 is up around about 1.46% in the last week, and these are all in their local currencies. By contrast, the Nikkei 225 is down around about 1.7%. Emerging markets are down around about 3.5%. And Asian equities, as a broad index as measured by the MSCI, is down around about 4%. Interestingly, the Nasdaq 100 is, as I make this show, only down around about 0.8%, but it was down until yesterday's rally about 3% on the week. So we're still seeing a lot of those rotations out of growth stocks, out of technology stocks in particular, moving into more value trades, which is evidenced by the Dow Jones hitting an all-time high, even though we've seen such an aggressive technology stock sell-off, particularly in the Nasdaq 100 over the last couple of weeks. Similarly, if you go over to Germany, so you look at the DAX has also hit an all-time high this week, and that's again because the DAX is more reflective of those value trades, those unloved, more traditional industries that are benefiting from this rotation out of technology and growth stocks into more value-orientated companies. And all of this is being driven by the rising yields we are seeing around the globe, but particularly in the US. Now, to take stock once again of where we are since this sell-off started, the Dow Jones is up 1.5%. Then a broad measure of European stocks, the FTSE Euro First 300, is basically flat since the 15th of Feb. The FTSE 100 is down around about 0.4%. The S&P 500 down 1.5% since mid-February, and that again is in local currency terms. The broad measure of the global stock market, so the MSCI All World Index, is down around about 2.4%. But if you look at Japan, Japanese equities are down around 3.5%. Emerging markets heading towards 7%. Asian equities down around 7%, as is the Nasdaq 100, which until yesterday was down more than 10% in correction territory. So we're still seeing these divergences. So from this, you can discern that if your portfolio was very concentrated in stocks in the Dow Jones and you avoided technology stocks and more speculative areas, so higher risk areas such as emerging markets and Asian equities, you'd be doing very well. So the things that were doing very well leading into this year are now being the laggards. And technology stocks have endured their worst streak in 6 months. So you can see there's a nuance to this sell-off. And in particular, we're seeing a lot of weakness in Chinese equities. And in just 14 trading days, the CSI 300 index has fallen 14% from a 13-year high. Now, that is happening against a backdrop of the National People's Congress, which is a closely watched political pageant that the authorities in China would not like to have a stock market collapse occur around. And the fact that we are seeing it is very unusual. Now, the authorities in China did intervene in markets this week via what is known as the national team, which is essentially national funds that start to buy equities, Chinese equities, when the market starts to collapse to try and push things higher and reduce the volatility and the sell-off. And they've had mixed success. In fact, when they first intervened at the beginning of the week, the market still turned around and fell 2%. In the last 24 hours, we've seen a little bit of stability in Chinese equities, and it's the Chinese tech stocks. It's really a technology stock rout that we're experiencing at the moment that is ongoing. So look at things like Alibaba, or 10 cents. So look at their share prices. You can see how much they've fallen in recent weeks. But although people were hoping that this week would start on a much firmer footing for global equity markets, it did start to take a turn for the worse. But by Tuesday, we saw some signs of stability. In fact, we saw the Nasdaq 100 close up 4% in a single day on Tuesday. So have we finally got to the point where the weak hands in the market have finally thrown in the towel and the market has now got to a point where it can rebound from? As I say, we've already hit correction territory on the Nasdaq 100. But could it be that investors are now looking for some value in those unloved technology stocks? We'll have to see how it pans out in the days and weeks ahead. But one of the key things that caused the turnaround on Tuesday was a receding in government bond yields. So we saw treasury yields break back down below that 1.5% level. We even saw gilt yields fall back. During the week, we have seen Treasury yields on the 10-year note in America push above 1.61. We've seen the 10-year UK gilt yield go towards 0.8%, which is why we saw that further weakness and this reflation trade continue. We saw commodities rise, but they too started to pull back when the dollar started to rise in response as people rush to a haven. The dollar tends to go up when we get a haven bid, when people start to rush towards safety. So we started to get the stronger dollar play come into markets as well. So that's another reason why emerging market assets have done particularly badly in recent weeks. But then in the last 24 hours, we've seen the VIX, the fear index, start to break down aggressively below the 31 level. It's now down to around about 23 as I make this show. The VXM, which is the equivalent I've spoken about on the Nasdaq 100, so the fear index on that, and that was up above 36. That's now started to pull back down towards 31. If it keeps going below that level, below that 31 level, in recent history, that's been a key threshold where below that level, we've seen strength in technology stocks. So could we be about to see a rebound? Now, the Chinese authorities have entered the market. The Central Bank of Australia tried to calm the markets a week ago. Are we going to see more central banks start to enter the market? At the moment, the Federal Reserve hasn't done anything, but if we do see that, if yields keep rising, then that could also unwind this reflation trade that we've been seeing, this rising yields on US Treasuries. But last week, I drew your attention to the performance of the sector averages of professionally managed funds. So they're the mixed share sectors that have varying degrees of equity exposure. What is interesting is that it continues to be the case that they almost fall in tandem. So if you hold a portfolio that is traditionally split between equities and bonds, then during this continued bout of weakness, there's not much hiding place. You will see both parts of your portfolio falling in tandem. As I mentioned earlier, the only real place you could have hidden is in those value stocks. So we're talking about some of the smaller companies and particularly the Dow Jones index. Last week, I also mentioned gold breaking down below $1,700 per ounce to keep an eye on that. That occurred and we started to see the value of gold fall even lower. That started to open up the door to a significant breakdown, but then that rebounded and we are back above the 1,700 level. So still keep an eye on those key resistance levels on gold if you invest in that in your portfolio. But all the while, markets are still doing this seesawing. We're getting relief rallies one day for them to only unwind the next. You may be wondering how long such a bond tantrum can last. Now, I wrote a note for 80/20 investor members last week, and to give you a steer, a lot of the things that are going on in the market, whether it be the traditional weakness we see at the back end of February going into March, or historical precedents of similar episodes of rising or rapidly rising bond yields, they tended to last at least 6 weeks, which would mean that that would take us into April. So the message is that things could get worse before they do get better. And will other central banks be forced to start to intervene in markets? So in the coming days and weeks ahead, keep an eye on the VIX that I mentioned. Keep an eye on it being below that key 31 level, which it is now. If it continues to push lower, that's obviously good for equity markets. Keep an eye on the German DAX. The German DAX has a correlation with US equity markets. So if the German DAX keeps pushing to new all-time highs, that's obviously very good if you're you're invested in European equities, but it does have a knock-on effect for US equities too. Keep an eye on the bond yield. So the 10-year US Treasury yield, does it break back above the 1.5 level, above the 1.6 level, and will it head up towards about 1.8, 1.9? That could cause some problems, but also UK gilt yields going forwards. Also, finally, keep an eye on the US dollar index, because a strengthening dollar could cause headwinds for a lot of assets, as I've mentioned in the previous episodes, so emerging markets, but also US equities. And the market as a whole, so the participants within it, are generally short. They're betting that the US dollar will continue to fall in the face of the continued stimulus from the US government, and potentially more stimulus, if we get it, from the US Federal Reserve. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com. The Twitter handle is moneytothemasses with the number 2. Of course, you can get hold of us via Instagram, Facebook. Don't forget to join our Facebook group where we talk about all sorts of things relating to personal finance and investing, of course. That can be found at facebook.com/groups/money to the masses. And of course, subscribe to our YouTube channel.